Hey, and welcome to Bite-Sized Crypto. On 2nd of November, the Fed is going to do another interest rate hike. Why is this important? Because the federal funds rate has a major impact on financial markets. And in this video, I will tell you everything you need to know about the federal funds rate and share tools with you that you can use to predict future rates. So, what is the federal funds rate? The federal funds rate is one of the main tools used by the Fed to guide monetary policy in the United States of America. It impacts all kinds of interest rates, such as the saving account rate, credit card rate, bank loan rate, etc. Why should investors care about the interest rate set by the Fed? Interest rate hikes from the Fed have affected prices a lot, no matter if it's stocks or cryptocurrencies. As an investor, you need to know about the interest rate in order to make a better estimate of whether the price of stocks and cryptocurrencies will increase or decrease in the short term. This chart shows developments in Bitcoin price since the beginning of the year 2022. I've marked out the CPI announcements with orange arrows and the Fed interest rate hikes using blue arrows. We can see that interest hikes always followed shortly after new CPI figures were published. Bitcoin prices fluctuated accordingly. How is the federal funds rate determined? The Federal Open Market Committee meeting is held by members of the Federal Open Market Committee at regular times. The purpose of this meeting is to discuss and decide on the monetary policy of the US. The federal funds rate is decided at this meeting. It is set 8 times a year based on economic indicators such as the inflation rate, unemployment rate, etc. The Fed regularly publishes all of the schedules for the FOMC meetings. The next meeting is scheduled on 1st to 2nd November. How does the Fed funds rate work? The federal funds rate acts as a guide to overnight lending among US banks. It is set as a range between an upper and a lower limit. Currently, the federal funds rate is 3 to 3.25%. The Fed uses interest rates as a tool to achieve stable prices and maximum employment. They raise interest rates when the economy starts overheating and experiences too much inflation. The Fed cuts interest rates when the economy is in a recession and has high unemployment in order to spur economic growth. What is the Fed's dot plot? FOMC's outlook is summarized in the Federal Reserve dot plot. There are in total 12 FOMC members, each of them is represented by a dot in the plot. Plus, each Fed branch president also gives opinions how high the interest rate should be. So in total, there are up to 19 dots in the plot. The dot plot was first introduced in 2012 to signal the transparency of Fed's policies. It is published quarterly. You should bear in mind that the forecast changes significantly each quarter based on how everything develops. As a result, it is not wise to rely on it too much to make investment decisions, especially in the long term. The dot plot is included in the Summary of Economic Projections, SEP. A link to the historical SEPs can be found below this video. The Fed Watch Tool. The CME Group uses the so-called Fed Watch tool to publish the latest probabilities of FOMC rate moves at their website. The prediction probabilities change constantly based on the information they collect. I will put the link showing detailed calculations below this video. You should definitely check it out. Will raising interest rates help to decrease inflation? Yes and no. Yes, if the inflation is caused by too much demand chasing a limited supply of goods. In this case, raising interest rates encourages people to borrow less and save more money, so that demand is reduced. As a result, prices become stable again. However, this does not work if inflation is caused by external factors, such as limited production capabilities and the Ukraine war, which cause energy prices to increase. Since energy is the master resource for every economic activity, increasing energy prices push up prices for everything else. And in this case, changes in the interest rates cannot help to reduce inflation. Can the federal funds rate go negative? Yes. Throughout the 2010s, interest rates in the United States were near zero. In Denmark, as well as some other European countries and Japan, central banks even lowered interest rates into negative territory. In other words, banks charged their customers to keep their money in their accounts. When was the federal funds rate established? Federal fund rates have been used since the 1980s to determine US monetary policy. Throughout the 80s, rates of more than 10% were normal, as the Fed wanted to combat inflation, which was at very high levels at that time. So how high will federal fund rates go? It is impossible to give concrete numbers. What is sure is that the Fed wants to push down inflation to 2 to 3%. we are still far away from this goal, and it can be assumed that interest rates will continue to rise accordingly. However, there are increasing signs that the global financial economy is facing a major crisis. Sooner or later, the Fed could find itself forced to deviate from its hawkish course in order to prop up the system to prevent it from collapsing. So these were the 11 things every crypto investor needs to know about the federal funds rate. If you found this video useful, please like, share, and subscribe. See you in the next one.